Embedded lending is pretty hot these days. There's hardly an embedded finance review newsletter edition where I don't cover a non-financial brand launching a new lending product. And this includes companies targeting restaurants, hotels, gyms, e-commerce sellers, and many more. But how are these companies offering the lending product? Do they choose the build or buy approach? And what do these approaches entail? In this episode, I speak with Mark Hollemann. Mark was one of the co-founders of Spring, an embedded lending provider which had a strong focus on B2B buy now, pay later. Spring was operating all over Europe with customers from various industries. But it did not work out, and Mark and his team had made the difficult decision to wind down the company. Today, Mark is working as an independent advisor and is helping companies to build and launch lending products. My name is Lars Markol, and this is the Embedded Finance Review podcast. Every 2 weeks, I'm interviewing the builders and shapers of embedded finance. And a quick reminder from my side, at Embedded Finance Review, we not only publish weekly newsletters, bi-weekly podcasts, and host in-person and virtual industry events. In addition, we also work with non-financial brands, infrastructure providers, and banks in understanding, designing, and launching their embedded finance products. If you're interested in working with us, visit our website and reach out. And now, let's dive in. Hey, Mark, welcome to the podcast. How are you doing today, and in what part of the world are you located right now?
Hi, Lars. Thanks a lot for having me. I'm based here in Amsterdam, in the Netherlands.
And today is a special day for Amsterdam, at least for the fintech folks, I guess. We're recording this on the 3rd of June, so it's the first day of Money 2020. Are you attending, or?
No, I'm not attending. I have attended in the past, back in 2022. I think for us, the side events are more interesting than the actual main event. And it's quite a big investment, so you really have to be very clear on what you want to get out of it. Otherwise, just stick to the side event.
I just want to say the frugal advice for startups, especially in the early stages anyway. Just come to Amsterdam, get a cheap hostel or a cheap room, and just go to all the side events. Obviously, the main conference is really good as well, but if you don't have the budget, you can at least get something out of the side events as well.
Yes, I agree. It is a great event. It is very well organized. It's just, it's very expensive. You really have to know what you want to get out of it.
Mark, thanks for joining. Today, we're going to talk quite a bit about the whole topic of embedded lending. Before diving into the nitty-gritty details of embedded lending, Mark, you are a co-founder of Spring. Spring was offering a B2B financing product, basically also like B2B buy now, pay later. You had to close down the company, or are shutting down the company at the moment. But obviously, you've seen quite a lot. So maybe you can share a little bit what you learned with Spring while building Spring, and maybe even while shutting down the company.
Yeah, we obviously learned a lot. It was an exciting 4-year journey. We founded the company back in early 2021 after coming from the Amsterdam Endler program, where I met my co-founders, Juan and Manoj. It was an amazing journey, 4 years. We built a great team, a great product. We got great customers. So everything worked there. But in the end, in the current investment climate, it just wasn't enough. Investors are looking for something different, something more capital efficient, something that grows faster. You can't just grow at any rate that you like. You have to take it carefully. You have to take it slowly. So we learned a lot. One of the things we learned is that building a lending platform is complicated, especially one that has to embed into the checkout of the merchant, where you have to make credit decisions and fraud decisions in a matter of seconds. So it's a complicated product to build, and it just takes a long time. Another thing we learned is that distribution is critical. Like if you don't know where you're going to get the volume from, or if the volume isn't there, then you have a problem. So it can become very costly and very complicated to get the volume to your platform. Like I said, with lending, you want to take it slowly. It's also something investors don't particularly like. It's easy to give people money. It's easy to pay out to merchants, to make loans. The complicated part is to get it back, and the critical part is to get all of it back, or the most of it back in good order, so you can redeploy it and obviously don't lose money. Europe is a difficult market. It looks like the European Union. It looks like one market, but in reality, it really isn't one market. It's very fragmented in reality, and you end up with a lot of different local winners rather than one. You end up with a German winner and a French winner and a British winner and a Dutch winner, and so forth, which further fragments the market, makes it difficult to get access to that volume that you need to get to grow your platform. So that's some of the challenges that we faced. Like I said, we built a great product, but growth, even though we did achieve 100,000 a month MRR, so we were above the 1 million ARR, things like that. We did achieve that. We achieved a 30% month-to-month growth for certain periods of time. But yeah, it just wasn't enough. It's such a capital intensive and such a long process that in the end we had to shut it down. And that process is now almost complete.
Okay, and now, Mark, like after basically like well, now, since Spring is not operating anymore in the process of shutting down, I think you decide to become an advisor or currently working with different companies in the space, advising them on potentially building embedded lending products. So we want to dive a little bit deeper into that, how companies are doing that, how can they do it, what the details, what the challenges are. But maybe to kick things off, I touched already on that like Spring was, I think, one of the products you offered was B2B buy now, pay later. It's
Correct.
like one buzzword, and it's like embedded lending. Maybe for all of us, you can kind of segment the space a little bit. Like when we talk about embedded lending, what kind of lending products can be really embedded? What can fintechs and non-financial brand actually offer?
Just embedding financial services is a very broad space, and basically anything you can think of, you can embed it into a platform or a marketplace or wherever you have users using services. But in the case of lending, I think it's a little bit more limited. And obviously, a big use case or a big example is buy now, pay later. And then you have on the consumer side and on the business side, and then you have a whole bunch of different types of products, whether it's just pay after delivery. As soon as you've received your order, you have to pay for the order, or it's 30, 60, 90, 120-day terms, or it's installment loans, or even options where you can lease equipment. Like all of these, I would consider buy now, pay later type products. Those are very good examples of an embedded lending product or an embedded credit product, which is embedded at the point of sale or whatever that might be. It could even be the store. It could be a marketplace. It could be a platform. I think the other big category is the merchant cash advances type products, where sellers on the marketplace can take out loans against the payment flows or the revenue that is generated through the marketplace. They can borrow against that. I think that is a perfect example of an embedded lending product, where the marketplace has additional data sources, data that maybe traditional lenders don't have. And on top of that, they obviously control some of the cash flow towards the borrower in this case. So that's a perfect example where embedded lending makes a lot of sense. I think those are the two main categories for me that come to mind.
And you touched already, obviously, there's, you mentioned around like buy now, pay later. So for consumers and for businesses, I guess it always depends on the type of the company, what kind of type of customers they target, is consumers or businesses. I think for Spring specifically, but also like the activities that I'm seeing and a lot of my direct network as well, there's a strong focus on business lending. And I think especially also with merchant cash advance, that's a specific product. Do you see, I mean, obviously you have completely focused on embedded lending for corporates, but do you see any kind of similarities between the two, lending for corporates or consumers, or they're two completely different vehicles?
Well, for corporates, it's a different product altogether, but with the consumers are in that sense a little bit more homogeneous, if you like. I mean, and I know there's differences, but you are one person, you're making a decision on your own behalf. You have your credit score, and based on that, you might get access to these products or not. Businesses, of course, ranges from everything to a freelancer all the way through a large enterprise, and the process is a little bit different for each of them. So I think, of course, the larger your business is, the better served you already are with financials, your banking networks and everything else. So I think the value really is for the smaller businesses. Then, of course, if you go to sole proprietor or freelancer, they behave quite similar to a consumer. So there's definitely similarities, but there's a big scale of types of companies, sizes of companies, which might behave different from consumers, but still aren't served by traditional financing or financial services channels. B2B is quite different, and it's quite different, or can be quite different, let's put it that way. But when you have the smaller businesses, they act more similar to consumers. So therefore, you see a lot of B2C websites or B2C e-commerce merchants that also sell to businesses, but it's more of an afterthought, or it's more like a small portion of their sales might also be to B2B, but the majority is to B2C. And then they need to, of course, have a solution. How do we serve those customers? Is it a very small business? Is it actually a very large business? And they all have slightly different purchasing processes.
It's interesting what you say. I think this is quite common in a lot of areas, that obviously let's call it a long tail, like these smaller, medium-sized businesses that has a very big number is really hard to serve, because it's first to reach them, to build distribution for them can be really, really hard, but obviously also to figure out who is ideal customer profile in this long tail and who can I really serve. But do you see, like, I mean, you said as well with Spring, you have been building these products now for the last 4 years and continue advising companies in the space. Do you also see the embedded lending model also being adopted slowly by larger companies, let's say companies who focus on larger clients, like more on the enterprise direction? Or do you think the real embedded lending action will remain in the long tail in the small and medium business sized?
So far, what I've seen is that's the most interesting group of customers. Just because like traditional banks historically don't really want to serve them. It's too costly to serve them, to onboard them, and to monitor them, and so forth. I mean, where do you make the cutoff point? You can cut it off anywhere, but let's say 5-10 million euros revenue. I think companies above that, all the way through to enterprise, are very well served, and banks want to have them as their customers. But it's that smaller segment of the market, like you said, that long tail of very small businesses that traditionally banks are not very interested in working with or lending to, or not even able to lend to, because they just don't have the data. They just don't monitor it. They don't know how to collect the financing back from these customers. And then they make a tiny little bit of revenue. So there you really need to rely on, do you have special data that others don't have? How much of the processes can you automate? How much of the risk can you mitigate by diverting part of the cash flows that are going towards the borrower? So I think it's still the big focus is that long tail of smaller businesses and how to serve them. And that's where embedded lending is perfect.
Makes sense. Then let's maybe put ourselves in the shoes of maybe one of your potential customers back in the days with Spring, or maybe today potential clients working with you as an advisor. Let's put ourselves in the shoes of can be a fintech, can be a non-financial brand, somebody who is not offering any embedded lending products today, but wants to go down that path. And for this episode, let's focus maybe on the B2B side, B2B lending, high level. When the company made the decision, yes, we want to offer lending. And I think the typical most important question whenever you build a new product is like, okay, should we buy it or should we build it? Maybe on a high level, these two options, buy versus build. Maybe we can dive a little bit deeper into them and see what options companies really have when it comes to embedded lending. Maybe you want to kick things off. What's your thought on like buy versus build? And maybe then let's go a little bit deeper into both options.
Yeah, it's a very good question. Even before Spring, when I was working at Riverty and where Amazon was my customer, there was always this discussion: should we bring it in-house? Should we build it ourselves, or do we outsource it and let somebody else build and operate it? It is a very important question. There's many different variables that you can look at, of course, but I think one critical question to ask yourself is like the financial service, like how core is it to the business, like that what you do? And so in our case, for example, with Spring, obviously for most e-commerce merchants, extending credit in the checkout, doing fraud checks, doing credit checks, that isn't their core business. It shouldn't be. Like even in general, if you look at two different companies extending credit to each other, or the seller extending credit to their customer, it's kind of, as one of our investors in Spring calls that, it's kind of bonkers. It's like crazy. Like why would one business that sells you products finance their customer by giving them 30, 60, 90, 120 day terms? It doesn't really make sense. It's a perfect example for a company like Spring to go in the middle and say, we are the specialists in providing that credit. So you want credit and you don't want to give it as the seller. So we go in between and we'll take that risk away from you. You just get paid up front. You don't have to worry about getting paid. You just focus on selling your core business, and the customer still gets what they expect, which is 30, 60, 90 day payment terms. So I think in this whole setup, I mean, obviously everybody wins because the merchant doesn't have to take that risk, doesn't have to worry about building that capability. The customer still gets what they want, which is the payment terms. And we provide the service. We earn our money with that, and we get access to distribution because the merchant attracts customers that we can then underwrite and earn a fee on. But then coming back to the build versus buy, I think the big question is like, how core is this lending product to your business? And how important as a revenue driver for you, or as a revenue stream for you, how important is it to be in control of the customer experience with that particular product? That's one thing. And then on the other side, of course, do you have the scale to justify the investment in building it in-house? Do you have the team available? Do you have the expertise in-house? And are you willing to invest in building that experience yourself? Complicated question that is really,
I guess that's what we got already. I guess on top of it, what you said right now to all these things is also, again, we have not specified is it a fintech or a non-financial brand, but what I'm seeing as well, not just an embedded lending, but overall the whole embedded finance space is also like, how strong is your conviction that this really makes sense, right? That this product you're building is actually the exact product that your customers need, right? I mean, if you're a fintech and you might have some very clear understanding of like what kind of like financing products and other details you want to build, okay, then maybe you want to go all in and build everything yourself. But if you are kind of have a guess that this makes sense and you've seen other people doing it, but you don't know all the details about the whole space, and kind of assuming you can build the perfect product just on day one seems a little bit like far-fetched, where probably it's better if you just like, let's say, buy something for the start, you validate your assumptions, your hypothesis, you can see what is really being used, and then in an iteration 2, 3, or maybe 4, you can actually build the real deal. But maybe even at that point, you also know I shouldn't do it because it's not so much, as you said, it's not so much as my core. And I guess what you said, like the example you chose with marketplaces, I mean, maybe you can look into that a little bit later as well. I guess what you said, like for marketplaces, B2B marketplaces, probably for most of them, it doesn't really make sense. It's quite far, as you said, like from the core. It's more about like enabling revenue for the core product, making more sales and not so much making money there. I guess there are also other companies who can offer lending products who are a little bit different, maybe not marketplaces, maybe the marketplaces, but maybe also completely other companies who have an interest to build it themselves. Let's maybe, obviously I can understand that's a very, very complicated topic and question, but maybe on a high level, let's say there is somebody who say, but I want to build it myself, Mark. I want to build embedded lending myself. What does it mean building it yourself? What building blocks, what modules, if you can call them modules, like what elements do you need to think about and tackle when you build your own lending product?
Yes, it's a good question. Just take one step back on your earlier point around marketplaces. I think they are probably one category where it does make sense for them to build it themselves at some point, because that is the value that they bring, right? They're connecting sellers and buyers. They don't actually produce anything themselves. They don't actually hold inventory themselves. They're buyers and sellers. And this is one of those services that they are taking away from their sellers. They take over from their sellers, and their margins are slim. So they might want to get access to other revenue opportunities or keep more of the revenue for themselves. And so that's also why I've seen it with Amazon. Like we started off working with an external solution, and over time they bring it in-house. Like you said, they learn how to do it, and they figure it out, and they don't want to take the risk to start and all of a sudden open the floodgates to defaults or to frauds and things like that. So they work with an external provider, and then over time, once they get comfortable, they bring it in-house and build it themselves. So I've seen that now in different cases. I'm currently working with the B2B marketplace, and they are doing the same thing. They work with external providers first. They weren't quite happy in some regards with the customer experience, and they see it as a strategic pillar for their business, for their marketplace. So they're bringing it in-house and then building their own solution. And when it comes to the building blocks, it's like I said at the beginning, it is very complicated to build a platform like this. I think the three main components are, other than licensing, which is obviously a very complicated topic on its own, and you might need a license or you might not need a license, are complicated. But ignoring that for a second, I think the main building blocks are the underwriting engine. So what you need to do to make the credit decision, to avoid fraud. If you have to do KYC on the user, on the end, whether it's a buyer or a seller on your platform or your marketplace, you might have to onboard them and do KYC. And of course, you have to do that then at scale. Most likely, you might have thousands of customers or thousands of suppliers that need to be onboarded and assessed. So that's a big component, a big block of the platform. The second one is the servicing. It's everything from calculating like how much should that borrower pay back per month, what is interest, is it just a fee? That in our case, it was just a fee that the merchant pays for the invoicing service. But in the loan, of course, there's repayments, there's interest calculations. You need to account for that and so forth. And you need to do collections. You need to be able to receive the payments back from the customer. You need to be able to disperse the payments to the seller. You need to do the reconciliation and so forth. And then lastly, because it is about lending, then you need that liquidity. You need that decision of, how am I going to fund this? Is it with equity? Is it on our own balance sheet with equity? Is it on our own balance sheet with loans? Am I going to find a model where I can do forward flow, where I can sell on the loans or sell on the receivables to another party? Like that's another big component to it. So I think those are the three big pillars of a platform.
So we have like licensing, which we kept out for now because it really depends on the product and the country. There's underwriting, there's servicing, and there's some money debt financing, basically. How are you doing that?
For this.
I guess, I mean, like looking at these like three blocks, I guess, obviously, again, each has their own challenges and obstacles. Servicing is, I wouldn't call it like straightforward, but that's basically, like, I think, something you have to figure out over time, what you need to build and how to do it. I guess like really interesting part for me from these like three blocks is the first one and the last one. The first one, underwriting, You mentioned it before already. I think there's this famous saying, it's easy to give out money. It's a hard part to give it back.
Yes.
It's the hard part of building a lending model. So obviously, and I guess even the underwriting, you can, like the KYC, the onboarding, I guess, I mean, these are all like challenges to overcome. That's, I would say, like normal product building, and you kind of figure it out in quotation mark. But then obviously with underwriting, you can kind of only know after a certain period of time if it worked or not, right? So I think there's also this saying very often that especially investors, when they look at like lending companies, they want to see that a person in the team, and the core team, has built a lending company before, has some experience, at least in this part, because that's not really something you want to like fake it until you make it kind of way. But I think like the underwriting part is quite easy to understand, but one of the core elements, right?
Yes, it is.
But
sorry, go ahead.
But let's say a company decides to still build it yourself. You said you have a client right now who's doing that. I guess there are still other providers. I mean, we are right now talking about the build option for embedded lending. I think we all understand that there are like KYC providers and other kind of providers you can still leverage. But obviously, it's something very different as where I buy a whole solution from one company and everything is put in that, and I don't need to put all the different bits and pieces together. I mean, there's still a couple of providers. I wonder in the underwriting part, even if somebody did not do underwriting before, are there like providers who can actually help you with figure this out, or is this always like depending on your unique data, unique customers, something you kind of left on your own?
It's a mixed answer. There are, of course, providers that can help you. So we worked as part of our platform. We had a decision engine by a company called Noble out of Israel. Unfortunately, they stopped operating, and we were going to switch to Tactile, which is a big provider of decision engines where you can upload and create your different credit policies and your decision flows for different types of customers or different types of or wherever they're based or what industry they're in and so forth. So you can create all your different policies. So there's tools for that. They come with quite often with like a data marketplace. So you have standard credit bureaus like Credit Safes and Shufas and Informas are already integrated, as well as some fraud providers like Xeons and other companies like that help you with managing the risks, the fraud risk side of the transaction. So there are ways to do that. But of course, over time, where you really add value is to build your own decision models based on the data that you have and what you've learned by actually lending out or financing transactions. And this is why, I mean, both VC investors, maybe a little bit less so, but especially debt providers that obviously only look at the negative side of the downside of any transaction. They don't look at the upside potential like a VC investor would, but they only care about the downside, what can go wrong. So they specifically want to see the track record. Like, have you done this before? How good is your underwriting policy? How good are your scorecards, the decision models that you use? How are you managing defaults? What's happening on the fraud losses side, on the credit default side, and so forth. So it's a track record, and the longer you're in the game and the bigger you become, the more data you have, and the less reliant you become on these more standard external providers of data, which is never really the most accurate data, right? It's always like historic financials from last year, which might not be relevant anymore today. So they help you, but it's not a perfect. It's better to have your own data, and it's even better to then leverage data from different sources. Like it's kind of tech-enabled lending where you use data from your PSP, from your marketplaces, from your bank, from your accounting system. You get a much more current picture of the business. But that all takes time, and knowing how to work with the data and how to make decisions and models around it, that all takes time.
And I guess this is also justification for the companies to offer these lending products, right? I mean, if you are a marketplace or whatever, but if you're just using the same metrics like a bank would be using, then maybe these companies are not served very well by banks. But if they are, then they're doing exactly the same thing. What you want to do is leverage this unique data that only you have and make better underwriting and serve customers better. You said something interesting point, and this also like brings me to the last piece of the build question, the debt financing. You said something like that these external debt financing companies look very much at the downside, which of course they cannot really participate in the upside. So they have to focus on the downside. Did I understand correctly what you said, that let's say there's a company who wants to build this and maybe they've done with a provider before, but now they're building their own underwriting and they build everything by themselves. Does it mean by definition that the first kind of like loans these companies to give out, maybe for a certain period of time, has to come on their own books before being able to onboard like a debt financing? Because what you might say is like they want to see some data, some traction, not from a buy option, what they did before, but from your own build option, what you have built with your underwriting. So it sounded like you kind of have to be the first financing. You have to finance the first loans yourself. Is that correct, or how does that usually work?
Yeah, I think that is a fair assessment. I think in the beginning, you do it with your own equity, then you might get an external provider in, and then obviously the data and the track record from those two will help you get access to a lender that might want to finance this. Like we did it in Spring. We first used our equity to finance these transactions, and then after in 2023, we finally closed our debt facility and set up a whole SPV structure. And that was only possible because the 2 years before that we had done everything on our own books with equity. Obviously, something investors don't like, but they understand that is a process that you need to go through. You need
Step by step.
Yeah, you need to exactly step by step. You need to build that track record, also build some scale to justify getting a lender in. So that's one side of it. But of course, if you're an e-commerce merchant and you don't really want to build any of it at all, you could just say, okay, I only want to work with an external provider through my PSP, for example, or just have them embedded into my platform or my marketplace. And I don't really want to consider building it myself. Then they could start from day one because the provider will do the risk assessment. And if they're comfortable taking the risk, they will approve the customer, regardless if that's the customer you've seen for the first time, or whether you don't do any underwriting decisions yourself as a marketplace or platform. So both is possible. But if you really want to do it yourself and be in control of experience, it's most likely that you will need to do it yourself first, and especially if you're a fintech or a marketplace. You will do it on your own books first, and then over time you switch. You can build your own. You can get a lender into finance transactions. It just takes time.
And then maybe before now switching to the buy option, obviously we spoke now a little bit about how to build it yourself at the buy option. But maybe before going to the buy option, I'm not sure if it's possible to answer this question, but when you look at the whole market, at the different companies who offer lending products, do you see there's more action on the build option or more on the buy? We know it depends a lot on the companies, but is there something where you say there's more happening on one side or the other?
Well, if you look at the number of players that provide buy now, pay later for consumers or for businesses, merchant cash advances and so forth, I think there's more parties that will end up buying a product or buying a solution than building their own. Like I said in the beginning, it's a very specific decision. If it's really core to your proposition, if it's really core to your strategy, it's core that you really want to control this. Or of course, if you are a PSP or you're already a financial institution that wants to add another product on, those are the kind of parties that will build it themselves. PSPs, banks, fintechs, and then certain marketplaces. They will build it themselves if you have the scale and so forth. But everybody else, they're better off buying a solution and just not basically focusing on that core business, which isn't probably providing a financial service. And there's plenty of options out there for B2B buy now, pay later, B2C buy now, pay later, merchant cash advances, and other kinds of B2B loans. There's lots of examples of companies doing it, and Banksware and others that are providing those kind of options.
Would you
the BNPL players?
And if you're looking a little bit like more close under the buy option, you mentioned a few names already. And I mean, we're both risking of like forgetting your name. So we're not going to try to mention everybody. So nobody's going to be stepped under the toes exactly. But still trying to like, how do you segment the market of like these providers, right? I mean, we spoke about the different financial products you want to offer. Obviously, if you want to offer, and again, let's focus more on the B2B side. Obviously, if you want to offer a buy now, pay later product or a cash advance product, then this might already reduce the number of providers. But is there, I don't know, if you were like having to draw like a mind map of like different providers in the space, how would you try to categorize them or put them together?
I think it comes down to, like you said already, it's either consumers or businesses. Who do you serve? And that is a main decision. And in the case of B2B, it could also be, let's say, a B2C merchant that sells to B2B customers. But it's a minor part of the product. So again, it doesn't really matter so much who you work with. You just need to have the option available, most likely through your PSP. But I think that how you segment the market is, of course, the type of product. Is it buy now, pay later? Is that what you want to do, which is unsecured, I guess, in the end, because you have an invoice or you have a loan, but there is no asset or real asset, there's no control over getting repaid, put it that way. So it's the type of products. Is it buy now, pay later? And then what do you need? Do you need just simple payment terms? Do you also want installments? Do you want to do leasing? For example, some providers that focus specifically on leasing in the checkout, and merchant cash advances then being quite a different product. I think what you really need to focus on is what industry are you in, what geographies are important for you, where are your customers located? The provider can cover all of Europe, for example. That was one of the strengths that we had at Spring. We said we can cover customers for you in any country in Europe, and we can take that risk away from you, which cross-border is a big thing. So are you more of a domestic player or cross-border? So if you're a Dutch merchant, you don't want to go chasing an invoice somewhere in Italy or in France or in Spain. You don't speak the language, you don't know the system. So you want somebody else to take that away from you. So cross-border is a big topic. What industry are you in? Some industries are a little bit more sensitive than others. What product do you need? Where are your customers located? And based on that, you can segment which provider best serves your needs. And another component is, of course, the business model. Are you a simple merchant or merchant of record platform, or are you really a third-party marketplace? Because then, that becomes way more complicated because then you have lots of individual sellers to be able to handle that.
Yeah, I do understand already, like this in the way that there are maybe some high level ways of categorizing these providers, maybe country or maybe the lending product that they offer. But a lot of the other things that you said to follow after is already like very much like characteristic of the product, of the features, of the functionality. And that's obviously like then gets like really, really hard to compare all these providers. So I guess if somebody, from your experience, if somebody goes through the buy cycle, again, maybe it's a non-financial brand who has not so much experience around this product. I see it in the banking space as well. I guess the common outcome is like speaking to a lot of companies and then trying to put together, trying to comparison. I'm not sure how you see it, but I see it quite a bit when working with non-financial companies, more on the banking side, is that trying to compare these providers, but then obviously sometimes certain knowledge and information is also missing. Obviously, you're getting all your information only from your sales counterpart from the other companies. So it gets really, really hard also to put the whole picture together, right? What's your experience? If there's somebody out there, and obviously I know the best answer is hire Mark, but let's say Mark is not available. Is there is there an advice you have for somebody going through the buy journey? Like what can be done to maybe ensure a better outcome?
Yeah. So what I would say is the easiest thing to do is almost run it like a mini RFP process. Create a one-pager which exactly describes what you're looking for, what's important, like what volumes are we talking about, what product do you need, where are your customers located, and so forth. And that information so that everybody's working on, or every provider that you contact is working on the same set of information. And then it's deciding for you what is most important. Like, do you just say, I just need to have this payment option in my checkout, for example, or I just need to have a loan product. But other than that, I don't care too much. Like, it's not that strategic to me or to my customers or to my stakeholders, or really need I really want to be in control, for example, of the customer experience. I want to understand, are they going to charge late fees to my customers? How are they going to communicate with them? How are they going to treat my customers? Is this really like, if they don't pay, that relationship is completely ruined because they go full aggressive on the customer, or they actually care about preserving that relationship for me so that this customer, once this matter is resolved, they actually continue to be a customer of ours. So I think there's a lot of aspects you could look at, but it's really just very important to first summarize the key points. What are you looking for? And then what is important to you? Is it pricing that is most important? Is it customer experience that is most important? Is being able to cover 90 or 100% of your customers, or you can end up with a provider that says low pricing, but then also they put the acceptance rate very low, for example, and they have 50% of your customers that I have to tell half of my customers they can't use this particular service. It's also not a good customer experience. So I think understanding it from those dimensions of what is important in terms of pricing, the service, the reach, the acceptance rates, and then having that really clearly written down for yourself, and then basically scoring these providers based on that, even though you're going to get the sales talk, and of course everything is possible and everything is wonderful, but try to talk also to other merchants that are already working with this particular provider.
Reference checks are key,
reference
right?
check, that is then knowing what you want, and reference checks. I think if you put those two together, then you should have a good assessment.
That sounds like some solid advice. Thanks, Mark, for that. Maybe final question. You mentioned already you're currently working with a marketplace that are currently helping building their financing product. Before the spring, I think you also had not only marketplaces, but quite a strong focus on marketplaces. Where's your personal excitement in embedded lending? Is it like really on marketplaces, or do you see some other type of companies as well, which you would like to, maybe not from advisory side of business activities, but like personally excited about when it comes to embedded lending?
I think it's a very broad field. I've been focused really on serving that long tail to small customers, small business customers, and trying to serve them where banks basically failed them. But it's interesting to see that also banks are trying to get into this space. And I work with ABN AMRO, for example, to help them launch their B2B embedded lending platform. That was last year. So you see even banks trying to find solutions, partnering with fintechs to be able to serve that segment of the market and to offer their customers a broader set of products and reach a broader set of customers as well. So no, I think for me, it's just like the making more financial services available to more participants in the market, where they need it, when they need it, and whether you are a PSP or a marketplace or a bank or a fintech, it doesn't really matter. It's like wherever the innovation is happening and whoever is solving these problems that's making distribution possible, that's giving access to financial services. Basically, I'm interested and excited to work with all these different providers that make this happen. And
that's a nice closing statement. It also resonates with me a lot. I also remember, like, even when, for me personally, now in embedded finance, but even back in open banking, people were asking me similar questions. What's the biggest use case company or innovation in this space? I often say it's not just one company doing it for everybody. It's more about a lot of companies doing it for their customers. So we have lesser big front page news stories, but more like across the board, there are more financial services being offered to these companies, more tailored, suitable, to be better served as well.
Yeah, and it is really like, and I think I gave an example in the beginning. If you are a marketplace seller, for example, on Amazon or bol.com here in the Netherlands, you might not be able to get access to a loan from your normal bank, but you are able to get it through your marketplace. And you then even see banks that are embedding their proposition in the marketplace. I think ING is doing it, for example, with Amazon in Germany. You see then banks also getting into that space, saying, okay, we can't serve you directly, or we can't give you a loan directly, but if it's through the marketplace where we have this extra data and where we have control over the cash flows and we can get repaid, then we're able to serve you. So you see banks also want to get in there. So it could be a fintech that is like a bank, where, let's say, for example, again, using that example, but that's the one that keeps popping up. They are embedding their services into an Amazon, let's say, or a similar marketplace, but also traditional banks are doing that. So I think this whole embedded topic is very, very relevant, just by giving types of businesses access to financial products that they otherwise couldn't access, whether it's a traditional bank or a fintech. Or a bank working with a fintech to make it possible and so forth. You see all these different combinations. That's exciting.
Agreed. Thank you so much, Mark. We will be publishing this episode after Money 2020 Europe is finished. So there's no chance to catch you on one of the side events. If there's somebody who wants to have a more in-depth chat with you around embedded lending and all these options, a good way to get in touch with you?
The easiest way is LinkedIn. Just connect with me on LinkedIn or send me a message. Otherwise, send me an email. I still use mark@spring.com. So you can reach me there or LinkedIn, both.
Perfect. Again, Mark, thank you so much for sharing. There's a lot of stuff to cover, so we couldn't dive into every little detail. So maybe there's some more for a later episode. But yeah, thank you. And until then.
Thanks, Lars. Thanks for having me.
Thank you for listening. And as you know, I'm always looking for insightful embedded finance stories, especially from non-financial brands. Do you know a company or a person I should interview? Please let me know. Until next time.